Hello and welcome to Stock Talk. Today we're continuing our coverage of Palantir Technologies, stock ticker PLTR. If you've been following our show, then you know that this is not just the second, but the third time we've covered PLTR. Why might you ask? Do we still think PLTR is a buy, or is it time to sell? Click like and subscribe to my channel below to stay in the know. Now, for those of you just tuning in, Palantir Technologies went public just in September of 2020, but the company has been around since 2003. Simply put, it is an American software company funded by the legendary Peter Thiel of PayPal and Steve Cohen. The company provides big data analytics to U.S. intelligence agencies and the Department of Defense. Private sector clients include hedge funds, banks, big pharma, aerospace, and the auto industries. Palantir clients include Morgan Stanley, Merck, Airbus, and Fiat Chrysler. Fun fact, the company was named after magical crystal balls used for communication in Lord of the Rings. Kinda gives the company some personality and intrigue, doesn't it? Now, despite its quirky connection to a fantasy novel, Palantir is a very serious business, and the intrigue doesn't stop there. It received its initial funding from the CIA's venture capital fund, In-Q-Tel, and was rated in 2014 by Forbes as one of Silicon Valley's most valuable tech companies. PLTR's rise to the headlines can be traced back to this year's meme stock frenzy and the famed Cathie Wood's ARK ETF's investment in the company. With this has come continued controversy given the stock's volatility and the company's profitability and long-term sustainability of its business plan. So, have we gone the way of the bears, or are we still bullish on this stock? Stay tuned and find out. Having hit a year-to-date high of $39 in late January, the stock currently stands at about $21 to $22. This is a significant relative discount, especially when compared to its 52-week high of $45. This dip can likely be attributed to a few things. First, as many investment managers have observed, there is currently a shift from growth stocks, such as PLTR, over to value stocks in the market. Second, the tech sector is also considered by many to be overinflated, though not everyone agrees. Third, many analysts have been bearish on PLTR, not the least of which is Carter Copeland from Melius Research, who, if you remember from our first episode on PLTR, took issues with what he saw as a rich valuation considering that Palantir still owes most of its revenue to existing clients. Now, is this really a big deal? Does that ultimately make PLTR a sell? We'll discuss this later on. PLTR may be an established company by now, but it is still a very young stock. Without much of a track record to provide us with many long-term metrics, we must rely more so on the quality of the balance sheet and its competitive strategy. More on this later on as well. As it stands, broad analyst consensus is that the stock is trading at a premium. After all, over the past 12 months, profitability is at a negative 103%, with a net margin and negative 125% return on equity. This means that while both revenue remains positive at $1.2 billion and gross profit is over $800 million, Palantir's bottom line still faces downward pressure from high research and development expenses and stock-based compensation to executives, the latter of which is, however, just a one-time expense. As for the former, R&D expense, it makes sense that a growth company at this stage would be making such sizable investments at the short-term expense to shareholders' equity. One of the many ways to value a stock is through dividing share price by earnings, sales revenue, and even free cash flow. Doing this provides us with a ratio that, when compared to its peers, can help determine whether or not the stock is over or undervalued. PLTR's price-to-sales revenue ratio of 25.37 is currently worse than 90% of software companies, with the median at 3.42. So, while that would at first imply it is potentially overvalued, it is important to know that PLTR's ratio has been declining over time, having previously been as high as 38.57, thereby bringing it to its current relative discount. Similarly, its price-to-free cash flow ratio at 767.6, while also declining, is still worse than 98% of the industry, which tends to find its median around 25. Free cash flow is a metric financial analysts use to determine how much money is available to directly increase shareholder value through dividends. However, as we stated earlier, the focus right now is not increasing shareholder value right now, but rather investing in R&D and, as we will talk about later, expanding market share into the future. Yet, with all this still being in progress, it's easy to see why some analysts may be bearish on Palantir's growth prospects and thus their valuation. However, this neglects to pay attention to the underlying opportunity and is underestimating emerging key trends. At the end of 2020, despite a negative profit margin, revenue came in at $1.1 billion. That represented a 47% year-over-year increase. Lesser known fact, average revenue per customer increased as well from $5.9 million to $7.9 million. Now, what does Copeland have to say about that? Surely, clients being able to spend more, whether they are existing or new, indicates a reliable and stable base income stream moving forward. And regardless, Palantir has already begun efforts to make its services available to smaller customers. First quarter 2021 revenue beat expectations. At $341 million, it was 49% ahead of guidance and 48% over first quarter of 2020. Client billings at $362 million are up 248% year over year. Talk about cash flow generation. Free cash flow itself is finally positive, coming in at $116 million for the first quarter of this year, up from negative $23 million the previous quarter. Moving forward, Palantir expects annual revenue growth of 30% in 21 and over the next 4 years, and its goal is ultimately to be generating revenue upwards of $4 billion by 2025. Even skeptical analysts are estimating over $3 billion by 2025. As I mentioned earlier, it is important to also analyze Palantir's competitive strategy within the context of its supposed peers. Now, I say supposed peers for a reason. Palantir is, of course, a software company. However, it offers something its competitors don't. It offers data analysis and integration at the enterprise level across different departments. It also allows clients to maintain existing infrastructure and software. Integration is the name of Palantir's game. This already differentiates it from Google, Facebook, and even Salesforce. It is this Data as a Service, or DaaS, that Palantir announced as of May 24th that will be expanding its relationship with the US Space Force and the US Air Force. This will be to the tune of $32.5 million. However, this is only the latest in a series of moves Palantir has already taken in expanding its business. A couple moves were announced as early in this year as January. On the 28th, Palantir announced it signed a multi-year enterprise agreement with Rio Tinto, a powerful multinational mining and metals corporation. Its software will be used to integrate data from mining operations worldwide. And on the 6th, Palantir announced it was expanding its work with Fujitsu, a Japanese multinational information and communications technology equipment and services company. Fujitsu is the world's fourth largest IT services provider by revenue. Both firms have agreed to an $8 million contract to distribute Palantir's Foundry platform to the Japanese market. Palantir's Foundry platform is its data integration software. Before this, Fujitsu was already a Palantir customer. Now, it is also its distributor. Talk about leveraging an existing client relationship to not only acquire new clients, but also expand market share. Again, I ask, where is Copeland from Melius Research? This is all in addition to remaining deals valued at $2.8 billion, according to Palantir's end-of-year 2020 10-K filing. So, while some analysts may be bearish, institutional investors are not. Out of 676 firms, 504 have increased their position in PLTR, and 287 new firms have initiated a position. Only 69 have exited their positions. Asset managers currently invested in PLTR include the household names of Vanguard, ARK, Founders Fund, BlackRock, and Morgan Stanley. So, as you have probably begun to realize, we still strongly believe PLTR remains a buy, no matter what the analysts may say. While the numbers may say that PLTR is still overvalued, PLTR is still a young stock, and the company behind it has strong prospects that big money is noticing, not to mention Big Brother. Like many tech stocks in their early growth stages, many metrics will be negative for some time, such as profitability and EBITDA. And despite its relative discount, some still believe there is still the chance that PLTR could fall further. If you find yourself in this camp, use a strategy that many financial advisors and investment managers use for their clients, a tranching strategy. Buy a little each month and average out the price fluctuations over time. PLTR isn't a day trade, it's a long-term value play. Thank you guys for tuning in. Let me know what you think in the comments down below. If you like what you saw, remember to hit that like button, subscribe, and turn on notifications so you don't miss out on more videos. And I'll see you guys in the next video. Thank you for tuning in.